A few months ago, someone close to me came to me with a problem. He had a lot of money saved up in a traditional IRA account, which in the United States is used here for retirement. And he was thinking about, should he just keep this money in the traditional IRA until he retires and starts withdrawing from it? Or should he roll over the amount that was in the traditional IRA in the next couple of years into a Roth IRA? If he keeps it in the traditional, that means he doesn't pay any income tax now. He pays that later in life when he's in that retirement period when he starts withdrawing. Whereas if he rolls over into the Roth IRA now from the traditional, he has to pay the income tax on that money now. And what he wanted to find out was, in which circumstance would he end up with the most money at the end of his expected lifespan to basically pass on to the next generation. And so he enlisted the help of a company that specializes in solving this type of problem for high net worth individuals. And you'd be surprised by what they quoted to have this type of analysis done. They wanted about 10,000 US dollars to analyze whether it makes more sense to keep the money in a Roth IRA, keep it in a traditional IRA, or roll it over into a Roth IRA. That to me seems like a lot of money for that analysis. So my goal in this video was to help people who might have the same problem. So if you have a traditional IRA that you're thinking of rolling over into a Roth IRA and you'd like to figure out, does it make sense to do that rollover, or does it make sense to just keep it in the traditional IRA? The model that I've built in this video will help you get that done. I plan to show you all of the different features of this model and how you can build it yourself. Or if you want, you can purchase the model on my website for much cheaper than $10,000. So with that said, stay tuned and let's solve this problem. Let's start off with the inputs tab. So if you're doing this side by side with me, you can create a new sheet in Excel by hitting the plus and labeling it as inputs. And you can see each of the highlighted yellow cells and this goes for the entire model. Any cell that's highlighted yellow is something that's not a formula, so it's going to be a hard-coded value that you have to type in. So for this sheet, we're going to need the basic info of whichever person we're doing this analysis for. If you're doing it for your own portfolio, just put your own information in there. So the first thing we need is the current year. And I've set this up to be a formula, which just takes the formula today, and then it's wrapped in the formula year. So it gives us the current year of today's date. Everything else you're going to type in yourself on this page. So we need the age of the person. In this example, we'll be assuming they're 54. We need the age that they're going to begin withdrawing. And I just went with a standard retirement age of 65. So you can try to put in whatever year you think you might need to start pulling out of your IRA account. The expected age of death. So I've put in 90. This model works to a maximum age of 96 years old for the expected age of death. If you want to be more conservative, you can put in a higher value like 96, because that will make you plan to live longer so you don't run out of money later in life. This category is single or married. I set it up as a list, so you can select single or married. You could just type either one of those in if you don't want to make it a list. The traditional IRA amount is the amount that you currently have in your traditional IRA. You might say, Ryan, how does someone get $2 million into a traditional IRA? Like, can't you only put in $7,000 a year or something like that? Well, these high net worth individuals, they can do what's called a backdoor IRA contribution, which means they can put in far more than the limit that you would think someone would be able to put in. So yeah, a lot of people have millions and millions of dollars in an IRA account. So now this one, the 2024 required income pre-tax. So this is just going to be what you, and let's say if you're married, what you and your wife require right now to live in the comfort that you live in now. And if you're single, you would just put in, what's my required income to live the lifestyle I live now, assuming no savings, right? It's the income required before you pay taxes to pay all of your expenses. Okay? And now this category is the annual contribution pre-tax. So if you're contributing to a traditional IRA, so the pre-tax contributions, how much do you put into your traditional IRA every year? How much are you continuing to plan on to put into your IRA every year until you begin withdrawing? And then for these are just assumptions about the overall market. So the expected equity growth rate, I went with 7% because that's typically the annual growth rate of the S&P 500 index over the last 100 years or so. Bond growth rate, I went with 4% because right now long-term interest rates on treasuries are at about 4%. Inflation rate, I just went with the Federal Reserve's target of 2%. You can change any of these. If you want to be more conservative, you can change them to lower values. If you want to be more aggressive, you can change them to higher values for the equity and bond growth rates. And then for the long-term capital gains tax rate, this will depend on your income, right? So if you're someone who makes less than 518K single or less than 583K married, you can do 15%. If you make above those amounts, you need to do 20%. And then finally, for the rollover, whether you should roll it over into a Roth IRA, you would put in the expected number of years that you would roll over that money from. In this example, we're going to assume the person has an 8-year period where they're just rolling over even amounts each year. And then finally, this would be your reportable income for the current year. So we're assuming this person makes 200K every year. And now that we have all that out of the way, let's get started. For the first part of this video, I'm just going to show you if we didn't roll over into a Roth IRA at all, we kept all the money in a traditional IRA, how would this person's life play out? How much money would they have to withdraw from the IRA every year at the point in which they retire, etc. And then after that, we'll talk about a Roth IRA rollover. Let's create a sheet called Traditional IRA. And so Traditional IRA is we're going to be analyzing this person's life. And let me just go over on a high level what everything in this table is, and then I'll show you how you can go about creating it yourself. So I've designed this analysis to work so that each row represents a specific year. And this person ages every single year, and we can plan far out into the future. And like I said, this model works up until the age of 96. And then once you go past 96, you'll see some of these formulas start actually breaking. Okay, so I've designed this so it works in basically 3 phases. So phase 1, which I've labeled here, is up until the person starts taking out those contributions. And so I have put in this person's age to begin withdrawing as 65. So when we look at this, we're going to say phase 1 is basically every year of their life up until the year that they start withdrawing from this account. Phase 2 is going to be up until age 72. Now, why age 72? Because with traditional IRAs, there is something called a required minimum distribution that the government requires that you withdraw from your traditional IRA account once you hit age 72. So the analysis basically stays the same, and the formulas are going to stay the same for each of these phases, and then they might change once you get to the next phase. Okay, so phase 3 is basically from age 72 up until the point that you expect to die. Now let's go column by column and break down how we get these values. So we'll start off with year, and so the first one is just going to be input C3 plus 1. So input C3 is just the current year right here. And then we do plus 1 so that we start our analysis basically at the beginning of next year. Now, the next cell is just going to be equal to the previous year plus 1. And you can just shoot that formula all the way down to the bottom so that each row increases by 1 all the way. Now, age is just going to be equal to the person's current age on this sheet So C4, and then we're going to add 1. Basically, we're making an assumption that might not be super accurate, that they turn, that their birthday is basically at the start of the year, not a big deal. And then the next one is just going to be equal to the previous age plus 1, and we can just shoot that formula all the way down, so they age 1 each year for the rest of the model. Now, required income is going to be based on two things. And this formula might look a little bit crazy at first, but I'll walk you through it. So it's an if formula. So the first component of this is we're looking to see if the age is greater than or equal to C5. So the age is this value right here. And if you're wondering why it's formatted like this with this at age, it's because I formatted this whole table as a table right here. So if you go home, format as table, you can do the same thing and just click one of these. And then you'll see a similar syntax as what I'm looking at. So we want to see if 56 right here is higher than what's in cell C5 on the inputs tab. And C5 is the age that we're beginning to withdraw. So basically, we're making the assumption that we aren't going to do any withdrawals from this traditional IRA until we reach that age that we're going to withdraw at, which for this example, I put as 65. So if it doesn't meet this condition, it's going to be 0. Otherwise, the value, if true, is going to be this component here, which is the value of an input C9, which is the required income pre-tax, so that 125K, multiplied by 1 plus that input C13, which is just going to be the inflation rate right here, to the exponent of the current year of the row minus the year that we're starting the analysis at, so this will just be 1. So basically, we're going to compound our required income into the future based on however many years into the future each row is, applying the inflation rate that we expect to see into the future, so that our required income, once we need to start taking money out, is increasing at that inflation rate every single year. I want to talk about withdrawals. So this whole model is built on the total withdrawals that we need each year, which in this column, it's going to be the maximum of either that required income, so I might as well put it over here, the required income, this value that I just explained, or the required minimum distribution that the government requires. Now, let's talk about these required minimum distributions. So these required minimum distributions is a rule that's set up by the US government that says once you hit the age of 72, you need to take out a certain amount from your Roth IRA every single year. And these periods are updated every year. So let me just give you an example. So we're looking at column F right here, this RMD period column. And for 72, it's 27.4. Now, what does that mean? That means that for the amount that I've got in my IRA, and we'll get to this column soon, but the amount that I have in here, I need to take out this much divided by 27.4 in the previous year. That's my minimum amount that I need to take out. And where did these values come from? Well, they get updated every year. I've got an example. You can find them on this website here, bankrate.com. So it's just this period in years, and they actually give you all the way out to like 120 years old. So I basically just cut my table off at 96, but you could actually blow it out even further if you wanted to. And the way I set it up is I created a sheet called RMD periods, and I just pasted all these values in. If you're doing this or using this sheet or trying to build a model like this after 2024, you're probably going to have to relook up these values and update them. So that's why all these are highlighted yellows, because these are all manual inputs. Okay, so let's go back over here now to the traditional IRA sheet. So that's where we're getting these values in this RMD period is just a VLOOKUP from that table. If error, we're just going to give a value of 0. Now the RMDs, like I said, so if the age is above or equal to 72, then we're going to take the value in the amount before withdrawal column. Don't worry, I'll talk about this very shortly, what this is. And then we're going to divide it by that RMD period to get the amount. And then the total withdrawal for each year is just going to be either the max of the amount of income we need or the max or the value of the RMD. So in this example, you'll see the first couple years after the age of 72, the required income is higher than the RMD. But if we keep going further out, oh, it looks like this one, it's the RMDs. Yeah, at what age? At about age 75 is when it crosses over and this value starts becoming the RMDs and not the required income, if that makes sense. Now let's just go, and I'm going to talk about like how I got this amount before withdrawal column that feeds into the RMD column. So we're looking at annual contributions. And so this is just an input that feeds over from here, which is that annual contribution pre-tax to the Roth IRA of $10,000. And I just used an if statement. So if the age is less than the value of input C5, then we take input C10. So input C5 is that age to begin withdrawal. So basically, if the person's less than 65, then we're going to return a value of $10,000. And so we see that all the way up to before the age of 65. And that's basically when this phase 2 begins, is when that value cuts out. Now, the amount before withdrawal is in the first row, that's going to be equal to that annual contribution column of 10K plus input C8 will just be the amount that we're starting with. So that traditional IRA amount of $2 million. And then, so I'll show you how this column changes over time. So one thing I wanted to explain is that I'm basically allocating a certain percentage of this portfolio to equities and bonds, and I'm changing that percentage every year as time goes on by this scaling factor here. So since I have it set to 2%, you can see that at age 56, I'm saying we're 100% invested in equities. So in this yellow column, you would just basically put in what percentage your portfolio is currently invested in equities. So if you were invested in like 80% equities, you would just put that right there. Okay, but I'm going to change it back to 100%. And then scaling is how much do we scale into bonds every year. So if right now it's scaling 2% increases every year into bonds and 2% decreases in equities every year. We could change that to say 3%. So we're going to be more aggressive in how we change into bonds over time, right? And people often change their allocation from equities to bonds as they get older because they become less risk tolerant as they age, and that money needs to be used more immediate, and their time horizon for investing becomes shorter, which also decreases their risk tolerance. So now that we've broken down these allocation percentages between equities and bonds, I want to talk about the dollar values that we're investing in equities and debts in columns N and O here. But to make sense of that, we first need to talk about this column, amount after withdrawal. So amount after withdrawal is just simply going to be the amount before withdrawal minus the total withdrawal. So we're assuming that withdrawals from the IRA happen at the beginning of the year. And so we can see that these columns match each other exactly in this phase 1 period, but as soon as we start to get into phase 2, it's going to be different because we're subtracting that contribution away from that initial amount. And then once we've taken out our withdrawal at the start of the year, then we're going to allocate our portfolio between equities and debts. So basically, we're assuming that we're rebalancing our portfolio every year between equities and debts based on these percentages here. So the dollar value of equity for, say, this year is just going to be equal to that year's allocation to equity multiplied by that amount after the withdrawal. And then the same thing for the debt. It's just the amount allocated to debt multiplied by the amount after the withdrawal. If we sum up both of these columns, you can see down here, it might be a little bit small for you, but this value here will match that value. Okay, so let's keep it moving. So one thing that I wanted to show you is that the amount before withdrawal column can get a little bit complicated, because basically the way that we're going to increase this column's value every year is based on our allocation to equity and debt. So let me give you this year as an example. So what we're doing is we're taking, so N5 is the dollar value of equity, and we're multiplying it by 1 plus input C11, which will be the equity expected growth rate of 7%, right? So we're just taking 1 plus the expected growth rate for equities, and we're multiplying it by the amount that we had in equities in the previous year. And then we're doing the same thing where we're adding 0.5, which is the dollar value in debt, and we're multiplying it by 1 plus C12, which is the growth rate that we expect in bonds of 4%. And then, so basically, this is going to give us the total appreciation of these two values from the previous year into this year. And then lastly, we're going to add our annual contribution amount to that total value to get our amount before we withdraw for the year. So this year in particular, after we get the growth of these values, and then we add our 10K annual contribution, we end up with this amount. And then we would, to get our amount after withdrawal, again, we just subtract the total withdrawal for the year, which is going to be 0 for that year. So now that you have a better understanding about this amount before withdrawal column, let's really quick jump back to the RMDs column. So this one is just, like I said, it's going to be if age is equal to or greater than 72. Then if the value is true, we're going to take that amount before withdrawal column that we just talked about, and we're going to divide it by that RMD period associated with that age, right? And then that's going to give us our required minimum distribution value. All right. So now let's talk about taxes. Everybody's favorite, taxes. That's what this is all about. So this is where things get a little bit complicated. I have this sheet here called Tax Brackets 2024. I've built this so that the tax brackets will update based on whether the person is single or married. So right now in inputs, I've got it set to married. So this is the tax brackets for 2024 for a married person. You can see this right here. Basically, this is the low end of each range in column C. This is the high end of each range in column C. So any income up to the first $23,200 is going to be taxed at 10% in 2024 for someone who's married. Any income from between $23,201 to $94,300 is going to be taxed at 12%, etc. And it just the rate keeps going up. These are progressive tax rates. And so I can change this really quick to single. So if you're following along with this video and you're single, you can see that these are the tax brackets for 2024. You might want to pause real quick and just hard code these down, or you can find them like on the IRS's website, etc. So I'm going to jump back to married real quick. So what I'm doing with this table is that basically all of these are hard-coded values. If anything, I should probably highlight them yellow to stay consistent with, actually, so I've made a another table over here where I hard-coded in the values for married and single. And so these are just the starting year. So for my analysis, it's going to be 2024. If you're doing this analysis in the future and the year's not 2024, you're going to want to update these values with whatever the IRS's new tax rates are. And this is for married, this is for single. And then so these formulas right here, these are just driven by an if statement. So if this person is married, then give me N4. However, if that's false, if they're not married, give me R4. So I'm just grabbing this or this based on whether the person's single or married. And then these formulas were essentially just dragged like that. So for each of these categories, we're just pulling the correct high end or low end based on the percentage. And then once we have all those values, we are going to, this is where, so once this year changes, I've got it equal to A3 plus 1, and I just shoot that formula all the way down. And so each one of these blocks just represents a year in the future of what I'm expecting these low ends and these high ends of these tax brackets to be as the inflation changes the tax brackets, right? Because, and I'll show you an example of this. So let's look at this. This is just expected to be C3 times 1 plus inputs C13. C13 is our expected inflation rate of 2%. Now, it doesn't matter if the value is 0, but if I drag it over here, now we're expecting it to be this value to increase from 23,200 all the way up to 23,644, right? And then if I just shoot those formulas all the way down, you'll see as we go out in the future, these buckets just keep getting larger and larger and larger because people in 2045 are going to be expecting to earn a lot more than people in, let's say, 2024. Now, one thing that my model does not account for with these changing tax brackets is state taxes. That was going to get too complicated for me because these low ends and high ends are different for each state. So this whole model will work it'll work properly for people that are in states with no income tax, like Texas, Washington. I know there's a bunch of other ones. But if you live in a state that has income tax for the state specifically, you're going to have to try to incorporate this into the model yourself by adding your own brackets or maybe adding to these ones. Here, you might have to make some approximations. Now that we understand all these tax brackets and how they change each year, let's talk about our taxes on the traditional IRA, which I've gotten in columns F and G. So the first thing we're going to want to find is the income in range. And what that means is that for a specific year and a specific tax bracket, how much income have we realized in that range? And then after we have the income in that range, we want to find the tax on the income that's in that range. So let's just go, I want to show you an example real quick. So we didn't start withdrawing till the year 2023. So the way I've set up this formula is that all of these should be 0 until we get down to 2023, and that's when we first start seeing some of these values. Now, this formula looks convoluted, but it should make intuitive sense after I explain it. So really the first thing we're doing is we're going to find the minimum of two specific values. Now, the first value is this here. That goes all the way up to this comma right there. The second value is from here to here. So the two values that we're trying to find the minimum of, I'll talk about this one first. We're finding the minimum of the high end of the range minus the low end of the range. Or, so that's the first value. Or here is a VLOOKUP. We're VLOOKing up, the lookup value is the year 2033. And then we're jumping over to table 2, which is just my traditional IRA table. And we're looking up from year to total withdrawal, and we're grabbing the 6th column of that. So if I show you this from year, that's the first, second, third, fourth, fifth, sixth column. So we're just looking up the total withdrawal based on the year. So for 2033, it's going to be 149K. And then if we jump back here, so we're taking that 149K right there, and we are subtracting by the tax bracket's low end value. So this is going to be the minimum of either 149K or 27K. So the value right there is 27K. And then you'll see that the difference between these two values right here is going to be about 84K, which is again lower than that 127K, etc. And then eventually we get to the point where the total income minus that low end is actually less than the total range. So this is where we find this is our top end tax bracket based on the income we earned for this year. And we really only earned about 36K of income in this tax bracket. You'll see this is also wrapped in a max function. So we want to find the max value between whatever that min function produces and 0, because we don't want to go below 0 for any of these. Now we've got the hard part out of the way for the taxes on the traditional IRA. So now we can find the tax in each range, which is really easy. We're just going to take the income in that range here multiplied by the tax rate for that range, and we can just shoot that formula all the way down, and you'll see once we get to 2023, like we're paying 10% taxes on this amount of money, so we're really paying $2,773 in taxes. And so for 2023, this is our total amount that we're paying in tax. One thing I want to point out real quick is like, so the income in range, so for 2023, for example, if we sum all these up, that sum, it might be hard for you to see, is 149,387. I can see on the bottom of my screen. So if I go to the total withdrawal amount for 2023, I should see that same value, 149,387. But so we get our total of the taxes paid for each bucket of each year. And then now we can jump back to our traditional IRA. And so here's where we're going to be finding out like how much money you can live off of each year off your withdrawals from the traditional IRA. So the tax paid on IRA or tax paid on withdrawal column is just going to be equal to, so it's a sum if, so we're summing if the range is column A of that tax bracket sheet, which is just the years. So here, column A, so we're grabbing all those years, and then the criteria we're looking up is the year for this specific row in this traditional IRA table, so 2033. And then our sum range is just going to be that column G, which is where we found the tax in each bucket, which is this value here. So we should see for 2023 that we're going to pay a total of $21,041 of tax on our withdrawals, which is what we see right here, $21,041. And then the post-tax withdrawal, so this is how much money you can actually live off of after you've paid your federal income taxes on that money, is just going to be the total amount that you withdrawed for each year minus the tax that you paid on the withdrawal. And so you can see that in the year 2033, this person will be able to have $128,000 to live off of. Now, I want to bring it back to the required minimum distributions here and talk about something that just slightly convolutes this analysis. We have this assumption that there's a certain amount of income that this person needs to live on each year, which is in this required income column right here. But then we also figured out earlier on in this video that there's a certain amount that the government will require that you distribute from your account every single year. So in events where my required income is greater than the RMD, there's really no problem for me. I'll be taking out my required income. However, when I start getting to the point where my required minimum distributions are higher than my required income, my total withdrawal exceeds the amount that I really need for my income. So what am I going to do with that extra money that I've taken out that I don't even need to spend? Well, I'm going to save it, right? I mean, anybody would. You're going to save it and you're going to put it somewhere. I would assume you're going to put it maybe into a brokerage account. So these last columns here, R through T, are going to be this person taking an excess of what they are pulling out beyond their required income that they need to live off of, and they're going to invest it in a brokerage account. I would assume that's how most people would behave, most rational people in a situation like this. And I'm just assuming 100% equity for this brokerage account, just as a disclaimer. So this RMD inflow is a value that I've calculated, and you'll see all these values are 0 up until the year where RMDs start to exceed the required income. Okay, so this column here is just going to be a maximum of that RMD value minus the required income, or 0 multiplied by the post-tax withdrawal divided by the total withdrawal. And so what I'm doing with this part right here is I'm basically scaling this to assume that we're getting an amount out of this value equal to the percentage that we end up post-tax of the withdrawal, because you wouldn't really be able to just invest 100% of the difference of this because some of it's going to be taxed. So, and then if error, just give us a 0 because I didn't want to break this formula as I scroll it down. So we'll see that in this first year, because the RMD hardly exceeds the required income, there's going to be a small amount of an inflow into this brokerage, only about $1,500. And then each year we're going to increase the so this is where I'm calculating the beginning balance of this brokerage account each year. Actually, maybe I'll explain that on the next year. So let's skip to the interest earned real quick. So the interest earned is equal to the beginning balance multiplied by input C11, which is just the equity growth rate assumed here. And like I said earlier, we're assuming we're 100% allocating the values in this brokerage into equities. So now let's talk about how do I get this beginning balance column. So let's say we're going into the second year. So it's going to say if this RMD inflow is greater than or equal to 0, then we're going to take the RMD inflow amount plus T23, which is this interest earned value, plus the beginning balance from the previous year. So each year we're taking our beginning balance of the last year, adding the interest that we earned for that year, and then we're adding the new inflow. And then our interest earned will be higher based on that balance going up, and we can sort of just drag this formula all the way down to see how large our brokerage value eventually gets by the age of 96, if we assume that we're going to live that long. So at this point, we've got just about everything we need to make a final analysis on our traditional IRA. So in this particular case, we see that we've got about 2.1 million left in our brokerage account at the age of 96. And then we also have about 3 million left in our actual traditional IRA. So now we can go and see, in this particular circumstance, how much do we have left to pass on in our inheritance to our descendants. And so I've got it built out in this table here, traditional IRA. And so there's two main things, right? It's the IRA's balance and it's the brokerage account. And so I've got this thing set up so that it's a VLOOKUP based on input C6, which is just the age we expect to die at. So I had this person's lifespan set to 90. So they want to know what's their inheritance situation going to look like when they're about 90. So this is based on a VLOOKUP of the age of 90 to our traditional IRA table, columns D through K, and we're looking for the 7th column in that range. So I'll jump back there. So column D is the age, and then 1, 2, 3, 4, 5, 6, 7. So we're going to find the amount before the withdrawal associated with age 90. So that is right here. So this value should be 4,218K. So that's what we're pulling in right there. And then the thing is that you need to keep in mind is when you pass on the inheritance for a traditional IRA, the government wants a piece of that. Unlike the Roth IRA, whatever's the value in a Roth IRA, when you die, you can pass on the full amount because it's post-tax money. Traditional IRA is not post-tax money, so the government wants a piece. The thing that was hard for me to assess is to determine the value of what this is post-tax, because basically the taxes that are taken out of this money in the inheritance is based on whoever you're passing the money on to, what income buckets or tax brackets does this income fall in for them? So I just made a broad assumption, which might be bad, that this money is basically going to be taxed at a 1/3 rate. So like 33.33 repeated percent. And your descendants are basically going to get 2/3 of this money post tax. Now let's look at the brokerage account. So the brokerage account, again, I'm looking at C6, which is age 90, and this V lookup, that's the lookup value. The table array is going to be going from age all the way to interest earned, and it's getting the 16th column. So I'll show you what that column is. So if we go over here to age, 1, 2, 3, 4, 5, 6, 7, 8, 9, whatever. So I'll just tell you because I know what it is. Column 16 is column S, which is just that beginning balance of your brokerage account. So if we go over to age 90, which is this row here, we should be pulling in a value of $1,015,000, which is what we see right here. And then the post-tax value is going to be... Oh, so the reason that the post-tax value is the same as the pre-tax value is because this brokerage income isn't subject to... this brokerage value isn't subject to an inheritance tax, from my knowledge, at least at the federal level. So the total inheritance value is going to be $3.8 million for the traditional IRA. Now, there's different ways that you can use this sheet to play with and figure out your own situation. So you can use this to see how comfortable of a lifestyle can you live. At what point does this value go negative is an important thing to keep in mind. Like, let's say maybe if I don't want to pass on all that much money, or I don't have any kids or whatever, like I don't need a bunch of money sitting there when I die, maybe I can increase my living standards. And I'm going to say that my current required income for the comfortability of life that I want is $140K. Let's hit that. Now we can go and see at what point does these values go negative. You can see I still am living pretty comfortably, and I'm not running out of money at all. So I'm taking out larger withdrawals, but I'm still got quite a bit of cash left over. Now my inheritance is less, but it's still a comfortable amount. Let's say, what if I change this to, I want to live like a super baller lifestyle, and I want to say that my current required income is $250,000 every year. Well, we might start to see that this thing starts to go negative by age 81. So I can't live this lavishly if I expect to live beyond the years of 81, because I'm eventually going to run out of money. And that's the cool thing about this whole tool, is that you can really figure out maybe the lifestyle that you can afford to live, or how much you need to save every year to live the lifestyle that you want to live, or when you can actually start retiring. Like, let's say if I actually change this to 150K, but then I wanted to push my retirement up to age 58, at what point do I go negative in that scenario? It looks like, again, I'm still going negative at age 81. So let's say maybe I'll push off my retirement to age like 63. Now, at what point do I begin to go negative? Well, it looks like I'm not going negative up until age 96 at that point. So a lot of different cool things that you can do with this tool to sort of figure out the life that you can live based on your current age when you want to retire, your current contributions, your current value in your IRA, etc. Now, let's move on to analyzing the potential rollover into a Roth IRA from the traditional IRA. And I've got this sheet set up to look a lot like what we did with the traditional IRA. There's just a few different ways we need to handle this analysis. So we're going to start off same way as the traditional IRA sheet with a year column. We're starting at 1 plus whatever the year is today, right? So we had the current year there. That's cell C3. So we're just adding 1 to that. And then for the rest of this, we're just adding 1 to the original year, and we can just shoot that formula all the way down to the bottom. And then age works the same way. So we just take 1 plus input C4, which is just the person's current age. So we've got that set to 55. So if we go over here, that's just going to be 56 at the start of 2024. And then we're just going to add 1 to this first value and just shoot that formula all the way down. And we can just let this go out as far as we want to. Like the previous one, this is just going to work up to basically age 96. So there's a few different sort of interconnected columns in this. So we've got our traditional IRA amount, which for this first row is just set to input C8, which is going to be equal to our initial value here for the amount in the traditional IRA, which we've got set to 2 million. Now we've got column E, which is the amount that we're going to roll over every year. And this is a bit convoluted math formula, but basically the way I set this up is so that it just takes, so if this value B4, so this year, minus the value in C3 is less than, so input C3 is that 2023. So that's basically saying if 1, so 2024 minus 2023, so 1 is less than or equal to inputs F3. So if it's less than or equal to this total value or rollover in years of 8, then we're going to return a value. So basically what this if condition does is just basically only return values that aren't 0. So if it's false, it's 0. So values that aren't 0 for the first however many years we've listed right here. So if I change this to 9 years, we would see that this now goes down 1 more year to 9 years total, but I'll go ahead and change it back to 8. You'll see one of those drop off. There we go. So back to 8 years. And so the value that it's going to return is just equal to that total amount in the traditional IRA at the start of the year divided by inputs F3, which is that 8 rollover years plus. So this little trick right here is basically how I'm making it divide it by the total number of years left. So inputs C3 was the current year of 2023, and then B4 is just whatever year is in that row, and then you have to add 1. So in this row here, this divided by this is going to be 8. Next year, there's only going to be 7 years left, so now it's dividing by 7. The next year, there's only 6 years left in the rollover, so now in this row, this is dividing by 6, etc. So we're just taking 1/8 of this value, 1/7 of this value, 1/6 of this value, 1/5 of this value, etc. Eventually, you get to the last year, and you just take 100% of that value to complete that rollover. And I'll show you why this is changing each year, but because this value here in this column is still going to be accruing interest, but we'll get into that. So let's talk about this column other reportable income and why it matters. So this other reportable income column is basically just how much we're making every year from, let's say, if we have like a salaried position or whatever other type of income we might have. So we declared over here in column F3, or sorry, F4 on the inputs tab, that we're making $200K every year in other reportable income. And we're going to make the assumption that, let's say, that our income until we retire or begin withdrawing at this age 65 is going to increase by the inflation rate of 2% for a year. So that's what we're seeing in this column. It starts off at 204K, and then if C4, so 2024, is less than or equal to that that inputs C5, sorry, I should say if our age 56 is less than or equal to that value in input C5, which is just going to be that retirement year over here, that retirement age. So if we're still equal to or less than that value, we're assuming that we're still working and we're still just reporting income that's increasing by that inflation rate every year. And the amount of years that we have to compound it by that inflation rate is just going to be equal to the difference in number of years from this year to the value in C3 here, which is our current year. So our income really just goes up 2% every year. And then the reason that we need to know this is for the tax information related to the rollover from the traditional IRA. So let's get into that, because this taxes paid column is just the amount of taxes that we're paying on this rollover amount. So here's how I've modeled all this out, right? So we've got 204K income in 2024. Now let's just jump back to the tax brackets page. So we're going to be looking at this Roth IRA tax table here. So in the other reportable income column, I'm putting in the income that falls into each one of these buckets from this other reportable income value. So see this 204K here? If I sum up these values for 2024 here, you can see it maxes out at the sum of 204K at the bottom of this screen. So 23,200 falls into this range, and 71,100 falls into this range, and then 106,000 falls into that this range, and then finally the last 2,950 of that original 204K values falls into this range here. And so the formula works the same way as that max of that function that I described earlier in the video for the traditional IRA. So we're just taking the minimum of two different values initially. The first value is this VLOOKUP right here. That is columns B through G, and then we're grabbing the fifth column we're looking up based on the year. So if I hop back to the Roth IRA table, we're going 1, 2, 3, 4, 5 over. So we're just grabbing that other reportable income. And then we're subtracting out the low end of the bracket there. So that's in this min function here. This is the first value. And then the second value is the difference of the tax bracket. So the high end minus the low end. So if we just drag this formula all the way down, we'll get our total other reportable income falling into each bucket. Now, this is where things might get a little bit complicated. So we've got this additional amount of rollover income, right? So like this specific year, 2020-24, we want to roll over $250,000, $250K is what we want to roll over into the Roth IRA. This $250K, it needs to roll over into the tax brackets after our other reportable income. That's the way I'm handling it in this model, because I assume you're basically stacking it on top of your current income if you're thinking about rolling it over, so it's going to get taxed at the higher brackets. So we need to figure out how can we get the 250K into the higher brackets and skip these first brackets. And so if you see how I've got this right here in this column rollover income, if I sum up all the values for 2024, you can see it sums to that 250K. So how did I do this? So I'll show you with this one. It gets a little bit convoluted. So first, we're going to do an if function. So if, and then we have a VLOOKUP, which is that Roth IRA B to G. It's looking up based on the year, and it's grabbing the fifth column. So the fifth column is going to be 1, 2, 3, 4, 5. So if this other reportable income of 204K plus, and then it's VLOOKUP up based on the fourth column there, same type of VLOOKUP, which is the rollover income. So it's saying if the rollover income plus the other reportable income is less than, now we're taking the low end of that tax bracket. So if it's less than that, give us a value of 0 because our income didn't get up to that tax bracket. However, if it is not less than that, now here's where we need to do some math to figure out how much money from the rollover falls into this bracket. And so what we're next saying is that if I6, so the year is equal to, I6, my bad. So if this other reportable income is equal to the total value of the bracket, then do 0 for the rollover income. And why is that? Because if this value, like this here, so if we go into this row, if this value I5 is equal to the difference in the bracket, then we know that this bracket is completely full with reportable income already, so we can just skip that one. That's basically what this if function's saying when we report a 0 if that condition's true. So, but if that condition is not true, then we're going to take, this is the value if false, we're going to take the minimum of either the value of the total value of that tax bracket on that row minus I5. The reason we're subtracting out I5 is because we have a certain amount already allocated to that bucket from the other reportable income. Or if this value is lower, we're going to take a value that's the VLOOKUP of the, so we're looking up tax bracket and then Roth IRA, B to G 4, which is just that rollover income minus the sum of the 4 rows above it. So what that's saying is that we're taking that other reportable income and we're subtracting out all of the income that we already reported that year. So this will make more sense if I look on this row. So we already allocated 179K, 179,900 in the previous 4 buckets for the rollover income. So we're going to subtract that value out away from the VLOOKUP amount of the $250,000 there, and we're left with just 70,100. Sorry, I know this is a bit convoluted, but it was really the only way that I could figure out how to make all this math work out. I hope you guys can follow this formula. Sorry about that. And then this last column, I should probably give it a name. It's just going to be tax on, I'll call it tax on rollover. And so what this is just doing is it's just going to take the tax rate associated with that bracket and multiply it by the rollover income of reportable income for that tax bracket, and we can just shoot that formula all the way to the bottom. And then when we come back over to the Roth IRA sheet, we got this taxes paid column, which is just a sum if. It's going to go based, the sum range is going to be the year bracket in this tax brackets table, or the year column. It's going to sum every row with the same year as the row in this table, and the sum range is going to be column K of that tax bracket sheet, which is going to be our tax on a rollover. So for the year of 2024, we should see a sum of these values, which is 65,608. I know it might be small for you guys. If I come back over here, we see 65,608. So now that we understand this tax paid column, there's really just one more column we need to get into before we can talk about our Roth IRA amount. So this is the contribution post-tax, and I made an assumption here that may not be the best one. So basically, we're going to be taking that if C4, so this should be our age, is less than C5. So basically, we're going to make sure we're contributing to this Roth IRA up until the age that we retire here at 65. So if this value is less than that, then we'll take input C10, which is the amount that we were contributing to our traditional on that pre-tax basis, so that 10K, and we're going to multiply it by 1 minus, and I just hard-coded in 0.25 there. I'm basically assuming that the government, Uncle Sam's going to take like 25% of that contribution, right? Because when we were putting that into the traditional IRA, it was untaxed. Now we have to apply a tax rate. So we're getting $7,500 every single year up until the age that we're right before we're basically going to retire. So I hope that makes sense for you. So the first row here, we're wanting to find our beginning of the year Roth IRA amount, which is 191K for that first year. How we're coming up with this for the first year is the amount we're rolling over from the traditional IRA. Then we're going to subtract out the taxes that we're paying on that rollover amount from the traditional IRA. So in this little red bracket spot here, we're just saying a rollover amount minus the taxes we're paying on the rollover amount. And then we're also adding that contribution post-tax. So we end up with the first year beginning amount in our Roth IRA of 191K. Now, let's skip withdrawals for now, and I'll get into that in a bit. Let's talk about the allocations. So this is functioning the same way I built it out in the traditional IRA section of this video. So this section here is just a percentage we're going to allocate between equity and bonds each year. This highlighted yellow cell is the amount we're going to start with in equity. So if really we were starting with 80%, I can just key in 80, the whole thing will update. The scaling factor is how much we switch from equities to bonds every year. So I'm assuming we go down in 2% for equities every year, and we go up in 2% for bonds every year. So bonds is just 1 minus the percent allocated to equities. And you can change that scaling factor. So if you wanted to have a less aggressive move into bonds, you could change it to say 1%, etc. So this columns N and O here is our allocations in cash to equities and debt, which is quite simple. It's just the Roth IRA amount at the beginning of the year multiplied by the percentage in equities for the dollar value of debt, just the amount in the Roth IRA at the beginning of the year multiplied by the percentage in bonds. This model assumes that you rebalance your portfolio at the start of every year to make sure that you are meeting these allocation percentages specified here. Now let's talk about what happens with this Roth IRA amount when we're accounting for appreciation in the value of our equity and debt in our portfolio. I'm going to get into a more complicated version of this formula. So we saw how it started in the first row. Now it's going to get more complicated. So let's see what it looks like in the next year. So it's starting off the same way. In this red bracket, it's going to be equal to the amount that we rolled over minus the taxes we paid on that rollover plus our contribution post-tax. But then we're also going to have to add the value in cell N4, which should be the equity, right? So our dollar value in equity that we had at the start of the previous year times 1 plus the amount that the equity appreciated in value. So if we look at input C11, that's just going to be the assumption we made about our equity growth rate over here. And then we're going to do the same thing for bonds, which is just taking O4, this dollar value in debt, multiplied by 1 plus the growth rate in that we assume for bonds, which was just that 4%. And then finally, we're going to subtract out our withdrawals for the previous year. And I'm going to talk about now about this withdrawals column. And so let's just jump into it. So you'll see it's 0 all the way up until age 65 is when it stops becoming 0. That's based on this if function here. So we're saying if age is greater than or equal to C5 of inputs, which is just that age we begin to plan withdrawing, which is like our retirement, our expected retirement year. So if this condition is met, then we'll calculate this value here. Otherwise, it's going to be 0. That's why we have 0 all the way up until age 65. So let's get into the meat of this formula and talk about what this is. So first, we're going to be taking inputs C9. So let's jump over there. Input C9 is just our required income pre-tax in 2024. So we have it set to 150K. So we're basically just assuming that that value is going to be increasing by the inflation rate. But there's a little bit more to this. So we're taking 1 plus that inflation rate of C13. So that value is 1.02, as you can see there, to the exponent. And we're basically compounding that inflation rate by the current year. So 2033 minus the value up here, B4, so the starting year. So we're compounding that inflation rate 9 times to increase our required income by the inflation rate. And now one thing that's going to make this a little bit more complicated is now we're going to multiply it by 1 minus this weighted average tax rate traditional. So the thing is, when we had our required income pre-tax, this is assuming this is the income that we needed to sustain the lifestyle that we were living, but it was on a pre-tax basis. Because now we're in the Roth, everything needs to be on a post-tax basis. So to scale this down, the withdrawal down to what we need on a post-tax basis, we're going to be taking a weighted average of the tax rate that we were paying each year in the case of the traditional. And so the way that you get that, I basically wrapped everything in an if error. So if error is 0, so once we get past that, we're going to take a sum if of the total tax we paid for this same year here in the traditional scenario, and we're going to divide that by the total reportable taxable income we had in the same year for the traditional scenario. So what I mean by that is, so we're going to take the value of column G for the year and subtract it by the sum of the value of column F for that same year. So if we go and look over here at 2033, we're basically going to be taking this sum here of 27K and dividing it by this sum here of 179K. And we find that we basically paid a weighted average tax rate of 15K for that year. And that's how we scale the withdrawals here to figure out how much money we actually need on a post-tax basis after we consider the withdrawals. So we now have pretty much everything we need to finish this analysis of the Roth IRA, and we can see at each year how much money that we can afford to live off of every year. So we can see our withdrawals. We're planning on living on 151K worth of money in 2033. We can see how our balance of our Roth IRA changes every year. So if we're planning on living to, let's say, age 90, expected age of death is 90, how much money are we going to have left then? So it'll be this row. So we're saying we have a 1,564K. We can play around with some of these inputs and say, oh, what if we begin withdrawing at 63? We want to retire a little bit earlier. How does that change everything? Well, now at 90, we only have 443K left, etc. And you can see basically how things change. Like, let's say if I'm contributing 15K on a pre-tax basis annually instead of 10K. Now I'm up to 600K, etc. And so we've got everything set up that we really need to see. Now this is really where we're going to answer that rollover question of whether it makes sense to roll over now that we've considered all these tax implications. So if I jump to this sheet here, traditional versus Roth inheritance. So this is accounting for the same age, right? So we're assuming that expected age of death is 90. So how much am I going to have an inheritance basically when I'm left at age 90? The traditional IRA scenario for this particular individual is saying that they'll have 1.2 million basically that their descendants can inherit from them. This will be left in their estate. Whereas with the Roth IRA, we're only seeing 601,000. I'll show you how I wrote this formula. So this is just going to be a VLOOKUP. It's going to be based on input C6, which is just the age of the expected age of death, 90. And then we're just going to be looking at the Roth IRA table. We're going from the age column all the way to the Roth IRA beginning of year column, and we're grabbing the 7th column, which is just going to be that value. So 1, 2, 3, 4, 5, 6. Oh, sorry. I started here. 1, 2, 3, 4, 5, 6, 7. So we're just looking up this value. So if we go over to age 90, we can see that it's $601,000. So if I jump back over here, that's this value here, $601,000. So you can start tweaking all these things. Like, what if I actually roll it over the course of 5 years and see, does your answer change? Actually, the gap between the two just gets wider and wider. What if I change this to 12-year rollover? The gap seems to close a bit. So you can play with all these inputs to see what allows you to end up with the maximal expected amount of money. And like I said at the beginning of this video, this file is available for purchase. Even if you purchase this file, if it's a bit too complicated for you to figure out, you can reach out to me on my website and hire me for custom analysis. If you need help answering questions like this, I can look at your particular situation and potentially your individual state's tax rates to come up with an even more personalized answer to the question of what does your retirement situation look like? How much money do you have left over at particular ages based on whatever assumptions you want to make. Hope you enjoyed this video. Please subscribe for more content just like it, and thank you for watching.